Hello, and welcome to another edition of Capitalism's favorite business model, the Ordway podcast. My name is Steve Keifer. I'm the Chief Marketing Officer at Ordway and also the host for the podcast. And I'm happy today to introduce our guest, Brian Parks, who's the head of Bigfoot Capital. And he's going to talk to us a little bit about venture debt and just what's going on in the capital raising and fundraising environment in general. Welcome, Brian.
Thanks, Steve. Happy to be here.
Great. Appreciate you making some time for us on a really important topic that I think in general, a lot of founders and executives are not as educated as they should be. So I'm hoping we can really dive into this here. But before we jump into the main topic, maybe just a few minutes about your story, your background and Bigfoot and kind of where you guys focus in the market, just so people have some context.
Yeah, sure thing. So Bigfoot, we're almost 8 years old next month. So started Bigfoot in 2017. Prior to that, graduated college in 2004. So kind of the prior 13 years was a hybrid of financial services and operational roles within software companies. Out of school, spent about 5 years doing lower middle market investment banking outside of tech. So helping companies, achieve sale events. So we were their sell side advisor. In 2010, jumped into tech companies, kind of employee one at an online travel distribution business, started what became an enterprise software company in the digital asset management space, marketing tech. I did a couple of other gigs at other startups. And kind of the last job I had before starting Bigfoot was at in a lending business, kind of a fintech model, doing lending, not lending to tech companies. And it was there that I really kind of incubated this idea for applying debt capital to software companies where I had been operating, where my network lied, where I had raised angel and venture capital, as had many of my peers. But I had seen capital structures deployed effectively, diversified capital structures, back in my investment banking days. Got into tech, and that just was not the case. Everything was equity funded. So I was like, hey, can we figure out how to provide, an alternative capital solution, debt, to these types of companies where I've operated? And that's what we've been doing ever since. And it's gone quite well, and we're very committed to that. And so, part of this conversations like these, is to just try to help inform people on the benefits of having a capital stack that's not just 100% equity. I'm not saying it should be 100% debt. Sometimes it can be, that's not the norm, certainly. But I think we are certainly advocates of like a reasonable application of debt in the capital structure of a software company.
Yeah, so I'm on my third startup in a row, and I definitely see the same thing that you were just alluding to, where, the first de facto thought that everybody on the board has and the early management team has is, we need more capital, let's go sell equity, go talk to venture capital firms. But I will say in all three of the companies, it didn't take too long before someone came along and said, hey, have you considered debt? And they ended up with a mix of it. So let's dig in a little bit on this. For the audience that I imagine most of the audience is familiar with the venture capital model and the positives of it, but maybe a little bit about kind of the downsides of potentially giving away too much equity and the dilution impact and that kind of stuff before we jump into the debt side.
Yeah, absolutely. I mean, so obviously dilution, right? There's only 100 points on a cap table. You can't expand that, and it's, who's owning it at any given time. And, if you start a company and you start it with a couple co-founders and you want to have employees of that company, that is a huge bet you're making at the end of the day on the value of that equity. And I think you should want to retain as much of it as you can for yourselves and your team as reasonable, right? So what I say is I'm not anti-dilution. I'm not anti-selling of equity. I'm anti-frivolity with equity. And I think way too many companies become too frivolous with their equity and effectively undervalue it, because it's almost like once you start selling equity, you get addicted to selling equity. You want a higher valuation the next time. You want more money the next time. And it's very easy to fall into that trap, I think, especially if you haven't fallen into that trap before. Once you fall into that trap and recognize it and look back and understand some of the potential negative impacts, you may not do it again. You may not do it in the same way. And I think, honestly, convertibles and really safes have really contributed to that as well. So those have been deployed for the last decade plus, right? And, it's easier and we should just do this. And you don't have to put a valuation on it. Frankly, investors have pushed that narrative, and which probably plays to their benefit. But at the end of the day, those are dilutive instruments. They're meant to convert to equity if if they're not equity day one. And so I've called that kind of like the convertible note overdose. Like you just kind of get in this cycle of doing it. So that's really dangerous, but it's dilution. The other aspect of it is really the path that you're putting yourself on, the bar you're setting to have success, successful financial outcome for all stakeholders. And that is a path that can be very hard to get off of. That's the main thing to me. It's like, hey, look, what we're trying to foster is successful financial outcomes for the folks running these companies and the folks putting equity capital into these companies. That's what we're trying to do with our capital, and step into a situation where we still feel like everyone can have financial success, right? And I think oftentimes over equity capitalizing a company can really compromise that. So one of the other things I say is we all think about TAM, total addressable market, what have you. Generally speaking, the way enterprise value is going to be realized for these companies is an acquisition. It's not an IPO. That hardly ever happens, right? However,
especially
there can be a lot of However, there can be a lot of software acquisitions. Now, I'd say most of those software acquisitions are sub $100 million. So if you raise $30 million of venture capital, that's not a successful financial outcome, generally speaking. And your board may even block that outcome. So come back to TAM, another total acquirable market is another way I think about it. Okay. There's only so many acquirers out there, be it financial acquirers, private equity firms, what have you, or strategics, that can take down a $500 million acquisition. There's only so many that can take down a $300 million. There's only that's very small. If you step back and say, I understand that there's much higher likelihood and a much broader pool of capital and acquirers that can buy me for 100 million, 70 million, 30 million. How do I orient my capital structure against that and preserve that optionality for myself? That's the way we want people to think about outcomes, right? And I think all too often people don't think about that and get caught up in raising a $10 million Series A at a $80 million post, whatever it is, right? And have really limited themselves and put themselves on a path that's much harder to achieve success, financial success.
So we covered the equity. We covered a little bit about kind of the need to have a mix and some diversification, but maybe drill down a little, double click a little on the debt side. What are some of the advantages of mixing equity with debt, and maybe a little bit about how the debt financing works?
Yeah, I mean, I think an advantage, it's basically the counter of what I just said. The two potential disadvantages of taking equity are, of course, the dilution and then the path you're putting yourself on. Inverse of that with that is you aren't incurring dilution, or you are incurring minimal dilution if there's some warrants attached for venture debt facilities. So, not dilutive. And, I think you're not putting yourself on some path that you can't get off of. So, the job of the lender, being a lender, one of the jobs is not to over-lever you. That's not lend you so much money that it compromises the health of your company. I'm not saying, it's always the easiest thing in the world to, service the debt, whatever. We all hope that it's not that hard to service the debt, right? But I would say if the amount of money lent to a company is reasonable, which everyone should want it to be, it is much less risky a part of your capital structure than the equity. Not just for the person providing the capital, but for the company itself. Again, it doesn't put you on some path that you can't get off of. You can get the debt repaid somehow, some way. You can. It's not there in perpetuity. I think people think it's way more risky to put onto a company than it necessarily is, and into the capital structure. The equity is there in perpetuity. You can't get away from it, right? The only way you can kind of get away from it, if you sell the company and it's successful, all fine and well. The only way you can kind of get away from it in another scenario is by recapping the company, which is going to come with a lot of pain oftentimes. So long as it's moderately applied, we never want our capital to back someone into a corner or put them on some path, because we are so understanding that, again, we want people to have a broad array of potential outcomes available to them. Raise an X equity round, don't raise an X equity round, cash flow the company, sell the company, whatever, IPO the company. We don't want to turn off any option. And our best way of doing that is by not over-levering companies.
So what's the process like to raise debt? I mean, one of the things that I always don't like about equity is it's just so time-consuming and distracting. It goes on for 3 to 6 months. You get caught up in all these debates about the valuation, and I just feel like it just such a distraction for the management team. How's the debt process in terms of time frame and what's involved in it?
Yeah, it can be a quicker process, certainly. I would say it's still, a comprehensive process though. So if I think about us, I'd say 6 to 8 weeks
Okay.
from kind of an initial conversation to a funding. If it's a bank, it's probably double that. Let's just say 3 to 4 months. Banks are slower. So it's not the world's worst process, but it's also not, we don't provide kind of click button capital, and many
Yeah.
others that I would say are providing millions of dollars don't or maybe shouldn't either. So, and I'd say if you've been through an equity raise before, it shouldn't be a painful process at all to go through, say, our diligence process or most lenders' diligence processes, right? You should have your stuff organized. You should have it together. You've been there, done that, and you just know what to expect, right?
And what is some of that stuff? Like, do you need audited, the three statements? What are the operating metrics you guys look at?
We don't need audited. Some do. Where we're generally playing is, call it sub $10 million revenue software companies. They generally don't have audits. I think for us, we will start to expect an audit. Once a company, say, clears that level of revenue, it's like probably a good idea and good hygiene, and you can afford to have an audit. Looking even beyond this debt financing, looking out into the future, like you want to show up to a potential acquirer or what have you, having had that done. It is to your benefit. But now for us, generally speaking, audits are not in place. The monthly reporting is pretty straightforward, not overly onerous. We're not taking a board seat. We don't take a board observer seat. Some may. We say, look, we like to be informed. We expect to be informed with the information. And if we're informed, two things. We're more comfortable, which is to your benefit, and we can probably be more helpful as well. So that's it. And that's in the form of financial statements. So hopefully you have an accounting system producing financial statements. Good. Get those to us. And, compliance certificate, which is like 1 page. And I'm adherent to my covenants, and we can get to covenants and what those look like. And maybe some customer level reporting. So a system like Ordway is great, honestly, because then all that stuff is organized and it is easy to provide, and we can consume it and frankly not bother you.
Yeah. Yeah, good point. All the invoices, all the contracts, all the revenue schedules. So in terms of when we're taking out debt, can you raise as much debt as you do equity? I mean, is there kind of a ceiling on it? And like, what's the typical term for a SaaS company that's sub 10 million? Is it 3 years? Is it 5 years?
Yeah. So the answer of can you raise as much debt of equity is somewhat depends. So I'll kind of separate venture debt from non-venture debt lending to tech companies. We are a non-venture debt lender to tech companies. And you can class this as like an ARR lender, lending truly against the revenue, regardless of how you're capitalized, frankly, from an equity standpoint. Venture debt lender, the way they're going to size their loans is as a percentage of the equity that you just raised. Which will generally be something like 30% of the equity you just raised. So you raised $10 million, here's $3 million in debt. They're then representing effectively 25% of your total capital structure. So no, you're not going to be able to get as much debt, pure venture debt, as you can equity, super tightly coupled to it. For us, who's more of an ARR lender, you very well could. Some of it's stage dependent, right? So where we're playing, we're providing something like 25 to 50% of the ARR. Okay. The $5 million ARR level. Once you clear 5, probably more so really once you clear 8 million top line, maybe you can get 50 to close to 100% of your ARR as a loan. 100% is going to be stretching it. Once you clear 10 million, 100, 1x ARR, 100% 1x ARR. Once you clear 25 million, you may get up to 1.5x ARR. We talked about ZERP earlier before we hopped on. ZERP days, maybe you're getting 2 to 2.5x your ARR. That's not really happening right now. So to say, though, that at any of those revenue multiples, it very well could be more than the equity available to you.
Makes sense.
And you can use it in conjunction with equity again, or you can use it in lieu of equity.
Got it.
The terms. So back to the terms.
Yeah.
I think just kind of the repayment term to hit on that because you asked. Can be as short as 12 months, can be as long as call it 60 months. That is also scale dependent. If you're very early stage with not much revenue and it's a really small loan, maybe expected to be repaid quite rapidly. If you have more scale, 10 million plus, let's just say 20 million plus, you may get 5-year money. Somewhere in the middle, and again, where we play, it's generally 3-year money. Companies do it, frankly, as low as 2. Not all that often, up to 10 in revenue.
Okay.
And I would say one other thought on that, is repaying money in 12 months that you've borrowed I have a hard time understanding how you get much value out of that capital,
Yeah,
frankly, and how you generate return on it. So I caution people on that front. Just to think about that. Hey, am I actually really getting value on this? Or am I just kind of having to continuously borrow and repay it rapidly? Then you're on a borrowing hamster wheel, which it just is not that beneficial for you. Overthinking 60 months is like, look, what we've seen across, 50 plus companies that we've worked with, again, we put out 36-month money. It's typically repaid sooner. Like it's
okay.
fine if it goes hold. It just typically has been across many, many companies that have repaid us. So while it seems great on, 5 years, 5 years, like oftentimes it's not going to go anywhere near that long. And you may be paying some other form of premium, let's just say, to get that extra 1 to 2 years that you really don't need.
Got it. Are there any downsides on the debt side? And I know that there are covenants, and you mentioned a few minutes ago that governance is relatively light, I think, compared to what we're used to on the equity side. Do you guys take any kind of collateral? What are some of the potential downsides that people should just be aware of?
Yeah, I mean, yeah, we do take collateral ourselves and others. Generally, the senior secured lender, so we're filing a blanket lien on all assets, including IP. And so these are asset-light businesses, as we're all aware.
Yeah,
So you can kind of say, okay, how valuable is that collateral at the end of the day? That's kind of suspect, but we still are the secured lender. And being the secured lender can be important because you still sit top of the stack, right? Which gives
yep,
you, even though you're not on the board, you're not whatever, gives you some protection and arguably potentially influence. And that's meaningful to senior secured lenders. So there's that. In terms of downsides, I mean, look, you have to service the debt. You have to repay it. You don't have to repay equity. Like, you don't, right? Hopefully you do repay the equity and deliver a return because that's good for you. But, you got to pay us interest and you got to pay us our loan back. If you're unable to do that, we're not heaping personal risk upon you. We're not taking personal guarantees, but there is potential risk to the business and the equity that has funded the business. Because again, we're top of the stack. So any senior secured lender in an absolute downside protect capital scenario is going to try to get as much of their capital back as possible. They may be successful. They may not be successful. You could say, all right, by having to service the debt, we're able to put less back into growth. Fine, I understand that. It is a use of money that is not hiring that other person, but also it's a source of money that has helped you hire those other people prior to having to repay it. And you're not incurring dilution. So, but that's a real thing to consider. It's really just that. Again, so long as you don't over lever your company, tend to think, of course I bring some bias, that like the true downside risk is just really not that high. So
Thanks for clarifying that. So you've mentioned a few times during the call, the ideally you kind of have a mix of debt and equity. Is there maybe this is a stupid question, but is there kind of a perfect ratio at different stages, or is it really just situational and different for every company?
yeah, I mean, I think it is stage dependent. So if you start at the latest stages, publicly traded companies in the NASDAQ, let's just say, I think are approximately 1-to-1 debt to equity currently. And that moves on a quarterly basis, frankly. But let's just say currently it's something like 1-to-1. So 50% of the capital structure is debt, 50% is equity. I think, for where we play, typically it's like, maybe 10 to 25% of the capital structure is debt, kind of when we're getting involved. So certainly not 50 to 50, and not zero, because obviously we're funding them with debt. Prior to us getting involved, it very well may have been 0% debt, 100% equity, and oftentimes it is. There's not some incumbent lender necessarily. At the earliest stages, again, for us, if you think about a revenue standpoint rather than a pre-seed, seed, A, B, whatever letter, purely equity, $2 million of revenue. Again, maybe it is 100% equity funded up until that time, I guess I would say. But as you progress, that 0% up to 50%, let's say at the highest end, can make its way. And we, again, think that's to the benefit of companies to consider and execute on as they keep getting further down the path.
Yeah, I want to switch gears for a minute. And the last question I wanted to ask you was, I know you guys put out a survey recently where you went out and asked a bunch of investors, both on the debt and equity side, about just kind of their sentiment on the market and how they're feeling about things moving forward. Maybe just kind of recap some of the key learnings from that for the audience.
Yeah, I would say, look, there's still a lot of capital out there interested in B2B software companies. Ours was focused on B2B software investors, both on the equity side and on the debt side, who ultimately care about the same things and are looking for the same things in their investments at the metrics level. So, what do people care about? Everyone still cares about growth. They do. It is the number one thing that they care about. That is what drives enterprise value, revenue growth for software companies, right? They're valued as a multiple of revenue. Everyone wants growth. These things are supposed to be growing. These things, software companies are supposed to be growing at somewhat inordinately higher rates than all other industries. That's the promise that is meant to be delivered by software, amongst other promises. The other promise is that the retention profile is there. That's the beauty of SaaS, right? Once it's there, it's effectively an annuity and it's sticky and it's high margin. You've got good operating leverage on the expense side. Like, that is what delivers the value. Those things aren't there, it becomes much less valuable. Investors, both equity and debt, care about the same things in the same order of priority: growth, then capital efficiency, manifested as burn multiple, really. Rule of 40 can be another thing, but that's actually deprioritized. Kind of goes growth, burn multiple, and then retention and gross. Those are the three main things, right? Like, it doesn't need to be more complicated than that necessarily. Focus on those three things. Don't focus on 50 metrics, in my view. That's what they care about. Still a lot of capital to be put out. Not like huge fundamental strategy shifts. We asked that question. I think the answer is no. And the answer has been kind of no for the past couple of years. It's the bar is higher. We are avoiding certain sectors. We are trying not to get caught up in hype. We are taking our time more. We aren't overpaying, all those things, which are, good and maybe arguably somewhat indicative of licking wounds from not having done those things for a handful of years. I think that's predominantly what's going on. Still a lot of folks that have capital at their disposal that are eager to deploy it, but, really looking for quality. So there is supply. It's interesting. I don't know if there's still supply of capital. There's demand for capital, but there's something in the middle that is the quality. Like, how do they get matched? When there is really good quality, they're still very competitive for those assets on both the equity and debt side. So valuations for those are still quite high. Debt turns for those are still quite good. But I think the supply of those opportunities is very constrained, and we'll see if it becomes less constrained.
So I know I said it was the last question, but you triggered me to ask one more thing. I know a lot of us are still kind of in this hangover from the good old ZERP days. Do we ever get back to that kind of heyday and craziness like we saw in 2020 and 2021, or is that a thing of the past?
So, I hope it's a thing of the past, because I think it's fundamentally unhealthy and just got ridiculous. Call it a bubble. I mean, so much overfunding at way overvalued companies that is frankly caused this huge hangover and a lot of pain for a lot of companies and their investors since that party ended. Not great. A lot of capital destruction, I think, in my view, a lot of poor outcomes for companies and the people operating those companies. Frankly, maybe a lot of undue excess stress, personal, mental stress, given some of those dynamics. So that said, we all have short memories. We're all human. Everything is cyclical, especially within financial markets. So yeah, it will happen. So the current flavor of that is AI. Right. And it's always good to have something to be excited about. And I don't want to discount the potential massive benefits of AI in the coming future. Yeah, it's the new, if it's ZERP, if it's something else, whatever it is, like, again, there's so much capital still there and eager to be deployed that it has to find some catalyst to deploy itself into. Anytime that happens, there's going to be, again, way overfunding and way overvalued and a lot of FOMO. And I think investors maybe understand that to some degree and are willing to go along that ride. Because again, it's kind of the power law concept of venture capital. Like, only a couple of these things have to really work out for their business model to work out. That's just what everyone should understand. If you're operating a company, you're not operating a portfolio of companies. You're operating your company, who, if you do get venture capital or debt investment, becomes part of someone else's portfolio. But that's not to your benefit. You still got to just focus on your own company. And eventually, at least in venture, it's a winner takes all mindset. Peter Thiel, I want a monopoly. Everything should be a monopoly. Which is, but for us, like, we're fine stepping in. We understand there should be competition. Our expectation is not that the companies we back are necessarily the market winner or have to be. So we have to be cognizant that, like, okay, like what's all this AI stuff going to do to companies that we've invested into or companies we're looking at, right? Of course, we have to be cognizant of that. They should be thinking about that. They should be executing against that new external, SWOT analysis. It's a external threat, but also an internal opportunity. So how are you, abating the threat, but really seizing upon the opportunity? And, there can be multiple winners in a broad array of markets that are using AI to still deliver value. But I know I'm going off script a little bit there. But yeah, back to your original question. No, I hope we don't go back to ZERP, but yes, we will. It just won't be ZERP.
Yeah, you're right. It'll be something else. I'm old enough to remember the com era. It wasn't that long ago, but a lot of lessons learned. Good. Well, anything else I didn't ask you about that you think the audience should know about, or anything else you wanted to share before we wrap up?
I think that pretty much covers it. I think back circling like highest level, again, what we're trying to do is help people think about their capital structures more strategically and understand how that can play to their benefit, hopefully over the long term, and how not to compromise. Like, what have we seen in the past couple of years that I think is really unfortunate? We understand that it has been a challenging environment for software companies the past 2 years in terms of growth and retention, just performance, right? Keeping on capital structure challenges on top of what's already a hard operational environment is just like another thing. And I think we've seen, a lot of companies that may be performing, quite well or holding their own in a tough market environment operationally that are just so kind of screwed up from a capital structure standpoint. It's like, man, that really stinks. Like, that's still a quality company. It's a good asset if you think about it that way for somebody, but the capital structure it has heaped upon itself doesn't align with that. It makes it very hard for that company to have success. We just see so much of that, and we want to see much less of that. And we want to see people be able to have, again, in our view, can be very good outcomes. Call it whatever, acquisitions ranging from $30 to $150 million. It's like, I've long wanted to have a lot more of those. And I'm not saying those are easy to achieve, but they're much more feasible to achieve than unicorn exits and IPOs. So if we could just reorient our thinking as an industry, both folks deploying capital and folks, trying to grow enterprise value, operating these businesses, I think that's long-term healthy. And I just still don't think we're there.
Yeah, well, it's a complex problem to solve. Maybe think of it as a journey rather than a destination. But thank you so much for taking time to talk through all this. I know I learned a lot. These are difficult topics to wrap your head around, but you explain it in such an easy way. It makes it easier to understand. So I appreciate you taking the time. And thanks everyone in the audience for tuning in. And we look forward to seeing you on the next edition of Capitalism's Favorite Business Model.